Hello everyone, my name is Ajitra. Today, this presentation or material, I will explain about principles of behavior in accounting. Accounting isn't only about numbers, standards, and calculations. At its core, accounting is also about human behavior. Yes, we solve ourselves. There's and principles or behavior at accounting explain how individuals such as managers, accountants, auditors, and investors make decisions when preparing, analyzing, and interpreting in financial information. Although accounting is designed to be objective and rule-based, the people behind it are influenced by perception, judgments, emotions, and personal incentives. Behavioral accounting studies how these human elements affect financial reporting, budgeting. You can also, you can say about it, financial budgeting on yourself, like the daily budgeting, performance evaluation, and strategic decisions. It recognizes that financial outcomes are not purely mechanical results of formulas, but also reflection of psychological process. Yes, we talk about trading, fasting. We know the analysis, technical analysis, fundamental analysis, but in the execution and field, it's about the psychological process works, bro. It is important, and just many people, large of numbers people did not realize. Cognitive and physiological factors play a major role in accounting decision making. Every financial decisions, oh, like you, what should I go to the next move? Involve interpretation, estimate bad debts, valuing assets, forecasting cash flows, or deciding on investment projects. Forecasting cash flow, yeah, you can say the company have the equity and cash, and you see the revenue and profit and net profit, all of the asset calculated and you predicted or forecasting, I can say. This process requires judgment under uncertainty. Uncertainty. Yeah. Uncertainty. Human cognition relies on mental shortcuts known heuristic to simplify complex information, while heuristic make decisions making faster and more efficient. They can also introduce systematic error. For example, an accountant may rely heavily on past trends when forecasting revenue. Even if market conditions have changed, a manager may become emotionally attached to a project and continue funding it despite client performance. These examples show that decisions in accounting are influenced not only by rational analysis, but also perception, memory, confidence, and emotional attachment. Cognitive bias are especially important in financial reporting and managerial decision making. Overconfident bias can cause managers can cause managers to overestimate future earnings or investment risks. Occurring bias occurring when individuals rely too strongly on initial information such as your budget when making new estimates. Prospect theory developed by Daniel Kahneman and Amos Tversky provides another important perspective on financial decision making. Unlike traditional economic theory, which assumes that individuals are purely rational and always seek to maximize expected value. You are wrong, bro. Prospect theory explains that people evaluate outcomes. Wait, peler. Okay, I will Sorry, the interruption there before. I will connect it. Outcome relative to reference points and perceived losses more strongly than gains. The concept is known as loss aversion. In accounting and finance, loss aversion can explain why managers delay recognizing losses, avoid selling declining, or take risks. Yes, people tend to optimism or oh, I expected this return will be high, but the reality you got to check by who? Well, check by market and strongly enough confidence. This despair must be come to you. In conclusions, behavioral theories and contain highlight that financial decision making is not purely rational. No, human not rational, bro. You believe the irrational? Huh. You are irrational too if you believe the human purely rational. It's stupid. Turn it on for pride yourself, bro. Seek what you do now. Cognitive limitations, psychological bias, and emotional reaction shape how information is interpreted. Understanding these behavioral factors is essential for imperfect transparency. Okay, thank you.